All right, so if you've spent any time on social media, you have definitely seen the hype around Forex trading. But what is it really? Well, today we're going to cut through all that noise and demystify the world's biggest financial market. And in just the next few minutes, we're going to build a solid, professional-level understanding of how this whole thing works. So let's dive right in and start at the very heart of it all. Okay, so everything in Forex, it all boils down to this one thing, the currency pair. And the absolute best way to picture this is like a weighing scale, right? On one side, you've got one currency, let's say the British pound, and on the other side, you have the US dollar. Now, things like economic news, interest rates, major world events, all that stuff adds or removes weight from either side, making the scale tip. And when we trade Forex, we're basically just speculating on which way that scale is going to move. Simple as that.
Now, we have got to be crystal clear on something right from the start. What we're talking about today is trading, not investing. They are two totally different things. See, investing is the long game, right? You're buying an asset to own it, hoping it grows over years as part of a bigger portfolio. But trading, and that's our focus here, it's all short-term. We're just speculating on which way the price is going to move, getting in and out of trades pretty quickly, and using tools like stop losses to manage our risk on every single move.
So, Section 1. Who really moves the market? Look, if we're going to trade, we have to know what we're up against. The market doesn't just move randomly. Oh no. It is driven by some massive players. We're talking deep pockets here.
And these are the real heavyweights. I'm talking central banks, huge financial institutions, hedge funds, governments, and massive corporations. These guys are moving trillions of dollars around for their own reasons. And us, the retail traders, we don't move the price, not even a tiny bit. Our job is to just follow the footprints they leave in the sand. So this brings us to maybe the most important mindset shift you'll ever make. Your job is not to predict where the market is going to go. It's to react to what the market is doing right now. Seriously, this one idea is what separates professional traders from gamblers. We're price followers, not fortune tellers. All right, Section 2, thinking in market layers. So if our job is to react, then the big question is, how do we actually see what's happening? Well, we need a map. And in trading, our map is built by looking at the market in different layers, or what we call time frames. The best way to think about this is that each time frame has one specific job to do. Your higher time frames, we're talking the 1 hour or 4 hour charts, they give you the big picture. They tell you the direction of the current. Are we flowing north or south? Then you have the lower time frames, like the 5 or 15-minute charts. That's your zoomed-in view. This is what helps you pick the exact moment to jump in and how you manage your risk. And you absolutely cannot get these two jobs mixed up. And this leads us straight into a professional process called top-down analysis. It's a super simple, super logical system. Here's how it works. Step 1, you figure out your bias, your main direction on that big, high time frame chart. Step 2, you mark out the key zones on that chart where you think price is going to react. Step 3, you drop down to your lower time frame and you just wait. You wait patiently for the price to come to you. And finally, Step 4, you only, and I mean only, pull the trigger on a trade if it lines up with your big picture bias. This single process will stop you from fighting against the market's momentum.
Okay, Section 3, a trader's core toolkit. Now, to actually read this map and use our top-down process, you don't need a screen full of confusing indicators. No way. You really just need two simple but incredibly powerful tools in your toolkit.
First up is what we call market structure. And all this is, it's the story that the price is telling you through its sequence of highs and lows. Think about it. Is the price making higher highs and then higher lows? Well, that's an uptrend. Is it making lower lows and lower highs? That's a downtrend. It's really about learning to read the basic rhythm of the market, not trying to memorize 100 different complicated patterns. The second tool you need is a solid understanding of support and resistance. These are just key levels where the price has turned around in the past. But here's a little quote that's going to save you a ton of frustration. Lines fail, zones work. See, price almost never turns perfectly on a single, exact line. It reacts in a general area, a zone. So instead of just drawing a thin line and praying it holds, pros learn to spot these broader zones where all the buyers or sellers have stepped in before. Moving on to Section 4, the most important rule. And I'm not exaggerating here. You could have the best chart analysis in the entire world, but it would mean absolutely nothing without what we're about to cover. This is, without a doubt, the #1 rule for survival and success in trading, managing your risk.
So let me just ask you this. What do you think is a trader's single most non-negotiable tool? I'll give you a hint.
It's not some fancy indicator, and it's not a secret strategy you buy online. It's something way more fundamental than that.
It is the stop loss. A stop loss is just an order that you place that automatically kicks you out of a trade if it goes against you by a preset amount. That's it. It is your financial safety net. But its job is more than just stopping the financial bleeding. It's there to protect your capital so you have money to trade another day, and maybe most importantly, it keeps your emotions from taking over when a trade goes south.
And let's be absolutely 100% clear on this. Trading without a stop loss isn't trading. It's gambling. Period. End of story. There is zero debate about this among professional traders.
So, we now know how to cap our losses, but what about structuring our potential wins? Well, it all comes down to a really simple but incredibly powerful ratio, 2 to 1.
The power of a 2-to-1 reward-to-risk ratio is a complete mathematical game changer. It means for every single trade, you're risking $1 to potentially make $2. So what does that actually mean? It means you can be wrong more often than you are right and still make money. Think about it. If you win just 40% of your trades using this ratio, your account is still growing. This completely takes away that psychological pressure of having to be perfect on every single trade. All right, Section 5, your first professional routine. So we've got the mindset, we've got the process, and we've got the risk rules. Now, let's put it all together into a simple, actionable routine that really separates the disciplined pros from the hopeful amateurs.
You know, a professional's trading day isn't chaotic at all. It's incredibly structured. First, before you even think about trading, you spend maybe 10 minutes prepping your charts and checking for any big news. Then, during your 1 or 2 hour trading session, guess what you're doing most of the time? Waiting. You are a sniper, not a machine gunner, just patiently waiting for that one perfect setup. You take at most 1 or 2 trades. And after, you take 5 minutes to write down what happened in your journal, and then you close the charts and you walk away. You're done for the day. That kind of discipline, that's freedom.
And that really brings us to the final, most essential truth of this whole thing. Look, long-term profitability in trading, it doesn't come from finding some secret holy grail strategy, or plastering more indicators on your chart, or trading more hours. It comes from boring old consistency. One simple system, one disciplined routine, one non-negotiable risk rule. Just repeated over and over and over again. That's not the social media hype. That is the actual process.